every night. While you're asleep, millions of dollars are changing hands. Some people wake up wealthier than they were yesterday, not because they worked harder, not because they got lucky, because their money had a job. Most people never teach their money how to work. Today, you'll learn why. And once you understand it, you'll never look at money the same way again. Most beginners get investing wrong before they even start. They think investing means picking the perfect stock, timing the market, copying influencers, buying whatever is trending, or getting rich quickly. That is not investing. That is speculation dressed up as confidence. Real investing is not about chasing excitement. It is about building a system that time can reward. If your money only grows when you work, your future is limited by your hours. But when you invest wisely, part of your money begins working beside you, even when you're not actively trading your time for income. That is what people mean by money that grows while you sleep. Not magic. Ownership. Here's what surprises most beginners. When you buy stocks, mutual funds, ETFs, or retirement investments, you are buying exposure to assets, businesses, and markets that may grow over time. Companies sell products, earn revenue, reinvest profits, pay dividends, and create value. Investors can participate in that growth. This is why investing is different from saving. Saving is money you protect for emergencies, short-term needs, and stability. Investing is money you put at risk for long-term growth. Both matter. If you save but never invest, your money may stay safe, but it may struggle to build real wealth. If you invest without savings, one emergency can force you to sell investments at the wrong time or borrow at high interest, so the order matters. Build basic stability first. Then invest for long-term growth. Many beginners feel stuck because the terms sound confusing. Stocks, bonds, ETFs, index funds, dividends, compound interest, risk tolerance, asset allocation. But underneath all the words, beginner investing has a simple foundation. Start small. Invest consistently. Diversify. Keep costs low. Stay patient. That sounds boring, but boring is often where wealth is built. The mistake beginners make is thinking they need something exciting. The hot stock, the perfect entry point, the market prediction, the quick win. But the market does not only test your money, it tests your emotions. Many beginners buy when excitement is high and sell when fear is high. They start during a good market, panic during a downturn, and quit before compounding has time to work. So the real question is not only, what should I buy? The deeper question is, can I build a system I will still follow when the market feels uncomfortable? Investing is not gambling when it is done with discipline, diversification, and a long-term plan. Gambling depends mostly on chance. Investing means owning assets with the expectation that value, income, or growth may develop over time. There is still risk. Prices can fall. Companies can fail. Markets can go through painful periods, but risk is not the same as gambling. Risk is something you study, manage, and match to your goals. That is why time horizon matters. Money you need next month, next year, or for an emergency should not be treated the same way as money you will not need for decades. Short-term money needs safety. Long-term money can usually accept more ups and downs because it has time to recover. This is why the beginner's greatest advantage is often not money. It is time. A young investor may not have thousands of dollars, but they may have decades for compounding to work. Someone who waits until they feel ready may have more income later, but less time. Time can be more valuable than the first amount you invest. This is the reason a 25-year-old can sometimes outperform someone who earns twice as much. Compound interest means returns can begin earning returns. A simple example is $100 earning 5%. After 1 year, it becomes $105. After the second year, it earns on $105, becoming $110.25. At first, that looks small, but compounding is quiet in the beginning. The early stage builds the habit. The later stage reveals the power. This is why small amounts matter more than beginners think. $10, $25, or $50 invested consistently may not look impressive at first, but it proves something important. You're becoming a person who invests before life spends everything. The first investment is not just money, it is identity. It says, "My future gets a share of my income." But small investing should still be intelligent investing. This is where diversification comes in. Diversification means spreading money across different investments, so one bad choice does not destroy the whole plan. It is the financial version of admitting, I cannot predict the future perfectly. Many beginners want to find one winner, one stock, one coin, one trend. But wealth builders often focus first on surviving mistakes. That is why index funds and ETFs are popular beginner tools. They can give exposure to many companies at once instead of forcing a beginner to depend on one perfect decision. They are not risk-free. They can lose value. But compared with putting everything into one stock, a diversified fund can reduce the danger of being completely wrong about one company. A diversified foundation is usually stronger than an exciting guess. Another beginner mistake is trying to time the market. They say, I'll invest when the market drops. Then the market rises and they feel late. Then it falls and they feel scared. Then headlines get worse and they wait again. Years pass while they wait for perfect certainty, but the market rarely feels safe before the best opportunities. There's almost always a reason to be nervous. Recessions, elections, inflation, interest rates, war, unemployment, or scary headlines. This is why dollar-cost averaging can help beginners. Dollar-cost averaging means investing the same amount at regular intervals regardless of market conditions. Instead of guessing the perfect day, you build a pattern. Every week, every paycheck, every month. When prices are high, your fixed amount buys less. When prices are low, it buys more. It does not guarantee profit, but it removes the emotional pressure of trying to predict every move. For many beginners, the value of dollar-cost averaging is behavioral. It turns investing into a habit, and habits are what beginners need most. This is where automation becomes powerful. If investing depends on memory, motivation, or mood, it will often get delayed. But if a small amount moves automatically into a retirement account or investment account, the system keeps working even when life is busy. The automatic investor does not need to feel inspired every month. The system carries the behavior. But before investing aggressively, check 3 things. First, emergency savings. If you have no emergency fund, a car repair, medical bill, or job interruption may force you to sell investments at the wrong time. Second, high-interest debt. If debt is charging high interest, it may be growing faster than a realistic investment return. Investing while ignoring that debt can become a hidden leak. Third, time horizon. Do not invest money you need soon. Rent money, emergency money, and short-term goal money should not be placed in volatile assets just because the market looks exciting. Investing should support your life, not put your stability at risk. Once those basics are clear, the beginner system becomes simple. Choose a long-term goal. Understand your time horizon. Start with a realistic small amount. Use diversified investments as the foundation. Automate contributions. Keep costs low. Reinvest returns when appropriate. Avoid panic selling. Review the plan, but do not react to every headline. That is investing for beginners step by step. Not complicated. Not flashy. A system. And this is where the mindset shift matters. Most beginners think investing is about intelligence, but investing is often more about behavior. Can you stay patient when progress feels slow? Can you avoid hype when everyone is bragging online? Can you keep investing when the market drops? Can you accept that volatility is part of the journey? Can you build a portfolio that matches your actual personality, not the person you pretend to be when markets are rising? If you cannot sleep during market drops, your portfolio may be too risky for you. The best investing system is not the one that looks most impressive. It is the one you can stay with during bad markets. A simple portfolio held consistently can beat a complicated strategy handled emotionally. This is the power of boring investing. Boring does not mean weak. Boring means repeatable. And repeatable is what gives compounding something to work with. Think of investing like planting a tree. Saving stores the seed. Investing plants it. Automation waters it. Diversification protects the garden. Patience allows the roots to grow. But many beginners keep digging up the seed every few days to see if it is working. The stock market does not move in a straight line. It behaves more like an elevator inside a tall building. It goes up and down between floors, but long-term investors focus on the building, not every stop. That does not mean every investment succeeds. It means your plan must be built for uncertainty. This is why beginners should avoid investments they cannot explain. If you do not know how the money is made, what could go wrong when you need the money, and how much you can afford to lose, slow down. Confidence without understanding is expensive. The goal is not to become a stock market genius. The goal is to become a consistent owner, because wealth is built through ownership. Income funds contributions. Contributions buy assets. Assets create growth potential. Growth creates future options, and future options are one form of financial freedom. Investing will not make most people rich overnight. It is not supposed to. It is a long-term system that allows your money to participate in growth while you continue earning, saving, learning, and improving. So if you are a beginner, do not wait until you understand everything. Start by understanding enough to begin safely. Learn the difference between saving and investing. Build basic emergency savings. Pay attention to high-interest debt. Choose one long-term goal. Learn what an index fund or ETF is. Understand your risk tolerance. Start small. Automate. Stay consistent. And keep learning. Your money cannot grow while it waits in the spending account. Your future cannot benefit from compounding if you never begin. You don't need perfect timing. You don't need perfect knowledge. You need enough understanding to take the first step, because wealth is rarely built by those who know everything. It's built by those who start early enough to let time work for them. And your wealth cannot grow if every dollar is only trained to be spent. So give your money a job, not a reckless job, not a hype-driven job, a disciplined, diversified, long-term job. Because investing is not about predicting the future perfectly. It is about building a system that benefits from time, ownership, and consistency. The beginner's biggest advantage is not having all the answers. It is starting early enough for time to become part of the plan. If this changed how you think about money, subscribe to Financial Awaken with Aaron for more insights that break down the hidden systems behind wealth.